Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The dollar is weakening, stock indices have lost their leaders, gold is in high demand, and Bitcoin's position appears shaky. The US dollar has experienced its worst series of daily declines since 2020, mainly due to the increased likelihood of an interest rate cut by the Fed and the improved positions of its main competitors. The pound is rising as fears about the budget have been allayed. The yen and the Australian dollar are awaiting interest rate hikes by their respective central banks. The euro is rising due to improved trade conditions, falling energy prices, and hopes for peace in Eastern Europe. The dollar index is further weakened by demand for hedging in anticipation of the Christmas rally in U.S. stock indices. The arguments of the first group of Fed officials seem more convincing. Hence, the futures market assigns an 89% probability of a 25 basis point cut on December 10th and approximately a 50% chance of a 100-point cut within a year. Since no further cuts are expected from the ECB in the coming year, the market is reevaluating in favor of Euro-USD growth. Moreover, even without divergence in monetary policy, the US dollar has many vulnerabilities. The potential cancellation of tariffs by the Supreme Court, the twin deficits in the budget and trade balance, and faster economic growth outside the US are all factors in favor of a further decline in the dollar. The US stock market is seeing a rotation of leaders. Technology giants made the most significant contribution to the April-October rally. However, the S&P 500 Information Technology Index is more than 4% below its historic peak, while many small-cap companies have almost regained their upward trend. This suggests that investors' concerns about the low return on investment in artificial intelligence have not been entirely alleviated. In 2025, the U.S. stock market is the underperformer among the 14 largest global indices tracked by Bloomberg. This also suggests a decline in interest in AI technologies. Since the beginning of 2025, the S&P 500 has risen 16% after rallies of more than 23% in each of the previous 2 years. In 2026, there may be even less. Bank of America forecasts growth in the broad stock index to 7,100, representing just a 4% upside from current levels. The main reason for the modest dynamics is said to be investors' loss of interest in big tech. The price-to-forward earnings ratio for the S&P 500 technology sector is at a 20-year high of around 28. Expectations of a cut in the federal funds rate and an increase in U.S. public debt to 129% of GDP by 2034 due to Donald Trump's One Big Beautiful Bill, creating a favorable environment for gold. November was the 5th consecutive month that the precious metal closed in the green. Geopolitical risk has not disappeared. Russia and Ukraine have yet to find common ground. The looming Supreme Court verdict on tariff abolition and a potential new shutdown are causing investors to hold on to gold. The higher the debt level rises, the more expensive it is to service. The cost of servicing the debt already accounts for 17% of the U.S. budget. It is not surprising that the White House is putting pressure on the Fed to lower interest rates as much as possible. However, if Kevin Hassett becomes head of the central bank and the number of FOMC doves increases, there will be risks of accelerating inflation. In such an environment, gold will also be in demand. The cancellation of tariffs will further inflate the U.S. budget deficit and national debt. At the same time, panic will hit the markets as investors will be unsure about what to do with the previously imposed tariffs. Demand for safe haven assets is expected to grow, allowing gold to continue its rally. Crypto traders are nervous, and institutional investors are waiting for the Fed's verdict. The wait-and-see approach is reflected in the growth of stablecoin balances such as USTD and USCD on crypto exchanges. This indicates that capital is being parked rather than being ready for aggressive investment. This is not surprising, as the cryptocurrency Fear and Greed Index is hovering in the extreme fear zone. Support from the SEC for companies using digital assets, allowing Vanguard Group clients to trade cryptocurrency instruments, and the creation of a $1.4 billion reserve to pay dividends and interest helped Bitcoin find a footing. As a result, Bitcoin has bottomed out and is attempting to counterattack, but its position remains shaky. The highlight of the second week of December will be the central bank meetings. The Reserve Bank of Australia will kick things off. Investors are expecting it to hint at a key rate hike in 2026, or at least announce the end of the rate-cutting cycle. The Bank of Canada has previously indicated that it will stop cutting rates due to the threat of accelerating inflation. it is unlikely that monetary policy will be tightened. Ottawa is engaged in a trade war with the US, which, combined with stricter immigration requirements, is leading to a slowdown in domestic demand. The Swiss National Bank received an unpleasant surprise from consumer prices. The risks of a return to deflation are increasing, so the SNB may reconsider its resistance to negative rates. The main event of the week will be the FOMC meeting. Hawks complain that continuing the cycle of monetary expansion will accelerate already high prices. Doves believe that it is better to play it safe and ease monetary policy to prevent uncontrolled growth in unemployment. Their arguments seem more convincing, so derivatives traders are confident that a 25 basis point cut will lower the federal funds rate to 3.75%. Follow the updates on global markets in Pro News Weekly. Like, share, and subscribe.